Fine Monday evening. I trust that all of you have had an excellent weekend. I trust that all of you had an excellent Monday. And I know beyond a shadow of a doubt, every one of you is looking forward to getting into class tonight. We are in level 2, class 5, which means we've made it all the way to candlesticks part 1. Of course, when there's a part 1, there's always at least a part 2, and there's part 2 coming up in Wednesday's class, in class number 6. But tonight we're going to get into the basics of candlesticks, and it's really not a big outline tonight. Candlestick introduction, and then we're going to talk about single candle lines tonight, and that's going to be our entire discussion on candles as we move forward this evening. So let's go ahead and jump right on into our introduction into candlesticks. And candlesticks are a unique analysis tool that we have that came to us from Japan. Interestingly enough, actually, they came to us from the Japanese rice traders. I always like to tell the story of this a little bit here. Back in the 1700s, the Japanese rice traders were trading rice very much like we would trade commodities. And what happened, in fact, a lot of people actually tracked the commodities market to the rice trade back in Japan, but that's another story. Anyway, essentially what happened in Japan is rice was the currency. And so you would have one farmer that would raise some rice up, and then they'd come into town. They'd say, well, hey, I need to trade for something, and the only thing that they had as a currency was the rice, and so they would trade the rice. And then, here you've got this shoe cobbler, and he's got all these shoes, and the only thing he can trade is the extra rice that the farmer gave him, or he's got more shoes that he could trade. So then, as you can see, the rice is the common good that ended up being traded. And then after a while, people started to have a whole lot of rice on hand. Well, if you've ever dumped a bag of rice, you know what a mess that can be. So to ease the carrying and the transport of rice, they came up with a very natural and normal solution. They started to bank the rice. And they actually had these nice rice banks where you would take and you deposit a bushel of rice. And then in exchange for that bushel of rice, you got a piece of paper that said, this piece of paper is worth X number of bushels of rice. And then it all just kind of evolved from there. So instead of trading rice, they traded the piece of paper that was backed by rice. And you can see how that would all flow out into a currency, not unlike our currency here in the United States, which started off as paper that was backed by gold. And of course, as the value of gold fluctuated, the value of that paper would fluctuate. Well, same thing happened in Japan. As the value of the rice would fluctuate, the value of the paper that the rice stood for, the rice backed, I should say, also fluctuated in value. And that created what we refer to historically as the rice trade. This became a very interesting history in terms of commodities and in terms of rice trading, because it created a whole interchange and a whole exchange that was all centered around the rice trade. And a lot of the technical analysis roots that we have go back to this particular time in history when the Japanese were trading rice. A very famous trader by the name of Sokyo Honma was trading in the 1700s. And for some of you who've studied a lot of U.S. history, you might be familiar with a man named Jesse Livermore. He's kind of known as one of the greatest traders in U.S. history, traded back in the Great Depression era of the U.S. stock market. Well, Sokyo Honma, it was kind of the Jesse Livermore of Japan. And so he's a legend in the world of Japanese trading. And somewhere back during that time period, all the beginnings and the roots of Japanese candlesticks got started. They were fully codified. There's a lot of vagueness in the history. We don't know all the details of the history, but they were fully codified and used very extensively by the time the Japanese stock market started in the 1870s. And so by 1870, they were very well established. But then they kind of became a lost art. And it wasn't until 1991 that a man by the name of Steve Nissen brought them to the United States. And he brought them to the United States actually not all on his own. There was a lady he was working with at a brokerage house. I always forget the name of the broker. I think he was with Merrill Lynch, but I could be wrong on that. Don't quote me. Anyway, Steve Nissen was working for a company, and a lady was working with him who was a Japanese girl, and she was hand-drawing these Japanese candlesticks, and he got fascinated by it and said, hey, that's pretty interesting. What is that? She shared the ideas with him, and then he went back to Japan on his own, started studying and started digging up some research, and brought the idea of Japanese candlestick trading to the United States, wrote a book on it, and it kind of became the Bible of Japanese candlestick trading here in the United States. That was again in 1991, and interestingly enough, the idea of the Japanese candlesticks then circled all the way back to Japan, and there are people today in Japan that would say Steve Nissen brought candlesticks back to Japan. So just kind of an interesting way that everything came full circle. I don't really know when the use of candlesticks stopped being prominent in Japan. They reemerged with Steve Nissen, but I'm going to assume probably somewhere around the Second World War when Japan was destroyed. We all know what happened in World War II. The United States went in and started to establish a lot of economic systems, and I'm going to go on a limb and assume, even though I can't prove it because I've never researched it, I'm going to assume that a lot of the history of the Japanese stock market had been lost up until then, and it was kind of replaced probably with the U.S. And then, of course, as I've already mentioned, a few decades later, Steve Nissen writes his book, brings it all back, and here we are today, 2012. It's very hard to find a good qualified trader who does not understand candlesticks and who does not want to use candlesticks. Now, I always say I'm a better trader with candles than without, but I could technically trade without them, and that is a true statement. However, I will say this. I am so accustomed to using candlesticks now that when I look at bar charts, I interpret them. My eyes literally fill in the picture and I see the candlestick. So while I say that I could trade with a bar chart now, I could do it, but in reality, I would still be using candles because my mind is transforming the data, and I can't really get away from it. So candlesticks are a very integral part of my trading, a very integrated part of most active traders, and you're going to be a much, much better trader for learning how to use these things. All right, so let's jump in here, talking about some basics of the candles. Each candlestick represents a time period, and that time period, of course, can represent any time period. It could be a day, it could be a week, a month, or, of course, any of the intraday time periods. You can have a 5-minute chart, and if you're in a 5-minute chart, then every candlestick represents 5 minutes. If you're in a 10-minute chart, every candlestick represents 10 minutes. And so whichever time period your chart is that you're looking at, that's what the candlesticks represent. Every candlestick is going to consist of an open, a high, a low, and a close. In terms of information, you got the opening, high, low, and closing price that will help determine and structure the candlestick. And of course, the candles are going to be distinguished by two colors. We've got the black candles and we've got the white candles. It really does become a black and white issue when we're dealing with candles. White candles are technically bullish candles, as we refer to them, as the close is higher than the open. The black candle is technically a bearish candle as the close is lower than the open. As I've already alluded to, they are built around the open, high, low, and close information. And the candlestick is going to be constructed of what we refer to as a body and a shadow, or some people refer to the shadow as the candle wick. Probably, to be completely fair, wick makes more sense, but technically we call it the shadow. All right, let me show you how this is going to work out here. The opening, high, low, and close is going to be marked as you've just seen it marked on my slide here. On a white candle, you're going to have the opening price at the bottom of the real body here. The low price is at the bottom of the lowest point, and the high price is the highest point of the day. And the closing price is going to be the top of the body. Now, this would be a white candlestick because the close is higher than the open. In the case of this candlestick on the right side, it's the exact opposite. We've got the open, the high, the low, and the close, with the open being reflected at the top of the candle body and the close being reflected at the bottom. So this is a black candle because we have a lower close than we have open. And anytime you've got a lower close than open, you've got a black candlestick. Now, kind of breaking down what we refer to as the anatomy or the construction of this candlestick here, we've got the shadow and the body. The black part or the white part is the real body. It's the body portion of the candle. The extreme high and the extreme low, we refer to that as the shadow or the candle wick. Now, we've got the upper shadow and the lower shadow. The upper shadow reflects the high price for the day, and the lower shadow reflects the low price for the day. Of course, you got the real candle body in there. Black body, lower close than open. White body, higher close than open. That's your basic anatomy of a candlestick. Now, a lot of people often ask me, they say, Jeremy, what if you've got red and green candles? And I never used to address this in the legacy program because, to be completely honest, in my humble yet very opinionated opinion. Red and green candles are kind of stupid. Not only do they look like a Christmas tree, they take out the integrity of the candlestick formation. I really do not like red and green candles. However, I recognize that more and more charting companies do it because people think they're pretty. And it's foolish, to be completely honest. And not only do a lot of charting companies do it, Trade Navigator does it. And so whenever you download Trade Navigator for the first time, if you don't import my templates, you're probably going to end up with red and green candles. And I hate that. But let me show you how they read. Basically, a green candle is going to be replaced with or white candle would be replaced with a green candle. So you can look over here on the right side, you see the white candles. And everywhere you see a white candle, I'm just going to circle several of them. Over here on the left side, you've got green candles. You see that? And then the red candles are going to be the black candles. So, they've just tried to associate it with a white day as an up day and a black day as a down day. So up is green and red is down. Well, it's bad because it takes out the structure of the candle. The candle body should be open, in my opinion. It should be a white candle body. It's an open candle versus a closed candle, which is the black candle body. When you deal with red and green candles, both candle bodies are closed. So yes, you technically can get the pattern, but they look different, and I don't like them. And that's me personally. If you want to trade with red and green candles, by golly, have at it. I really guess I don't care that much, but I personally really don't like them. Now, another thing that people will often say is they say, Jeremy, what if they're blue and white? And that's because Options Express actually has their chart pattern or their charting software shaded to the color of blue. This is not such a big deal because the white candle still reflects the white candle, and the blue candle in this case would reflect the black candle. Now, stockcharts.com, their free charting software has it color coded this way. They have white with red, and the red in this case would represent the black candles. So you can see, I mean, they're pretty similar. And anybody who, puts a half a thought to it can figure it out. It's not really rocket science trying to figure out what these different charting companies have done. Now, an interesting one is where they put it on black. And I believe Thinkorswim does this. A lot of companies that put a black background in their charting will do it like you have it over here on the right side, where you have the open candle and then you have a white candle, but it's a solid body. This makes sense to me. This one over here on the right. If I'm on a black background, it makes sense to have open candles, and then the full filled-in candle would be white or another shade that pops out on the black background. That makes perfect sense. Then a lot of people do the red and green on black, which again, I don't like it, but I certainly understand how they're doing it. So, whatever charting software you're using, you get the idea. That's how it's constructed right there. I just personally don't like it. Now, I see somebody writing in here, Jesse, has written in, what about a green hollow candle? Sometimes they show up. What's that? And actually, I can show you that. I will do that really fast because I have a template set up like that. And what you're seeing, if you see it as my template, is you're seeing the adaptive moving average. And the adaptive moving average, let me just zoom in here on the details so you can see it. The adaptive moving average, I'm fine with this. It's different though. It's not red and green. You notice what happens over here is you've got a green-white candle. It's a green outline, but it's a white body, versus a green candle, but it's a solid body, indicating that it was a black candle. Or in the case of the red ones, you've got red solid body versus red-white hollow body. That's okay to me because I'm still getting the white and the black. And then in the case of the adaptive moving average, you also have black and white. And what's happening here is this is a little indicator. I've never shared it with you, but it's a little indicator that essentially when you've got the green on, you theoretically have a green or a bullish trend. And when you've got the red on, you theoretically have a bearish trend. And the black is theoretically a neutral trend. Now, I've tested this indicator a lot. I like it, but it's not nearly as reliable as the colors would lead it to be. So I've never presented it to you guys, even though I think it's kind of cool. But Jess, it was a great question you asked. That's how the green and white work here. And again, technically you can use your candles however you want to. I personally just really feel strongly to see the white candle for an open body and a black candle for a closed body. That's personally how I feel about it. And you guys can take that for what it's worth and apply it how you wish to apply it. If you are in Trade Navigator and you ended up with a chart template, let me just show you this really fast. If you're in Trade Navigator and you have a chart template that is actually showing with red and green candles, let me show you how to get rid of it. You're going to right-click on your chart. So you just right-click with your mouse, and I'm right-clicking and nothing's happening. What am I doing wrong? Oh, there it is. Okay, I was not right-clicking. Oops. I thought I was right-clicking. I was right-clicking with my pen, but it was the wrong right-click. How's that? All right, so you're going to right-click on your chart. That'll bring up this little menu right here, and the first one says Edit Chart Settings. When you release that, you'll get this picture, and let me see if I can't zoom in so you can really see it. Oh, nice and big. Look at that. Okay, so you right-clicked on your chart, you clicked on Edit Chart Settings, and then you're going to make sure that you've got this price panel highlighted right here. And over on the right where it says Appearance, you see where it says Use Up, Down Colors. You're going to select that, and then you just saw what happened to your candlesticks here. It just turned them into red and green. And so that's how you actually get red and green or turn them off. And you can actually use whatever colors you want. So you could change all these to be, purple, and you can have purple and gray. You can do whatever you want with Trade Navigator. It's one of the coolest things about it. But I turn those things off. I don't like to have anything other than the black and white unless I'm using that adaptive moving average. The adaptive moving average makes sense to me. Anything else really does not. Okay, so hopefully that helps you there. All right, Mariana has asked a question. It's going to get me off my track here. Innocent question, again, not hard to figure out. Red or green volume bars. Look at it, guys. It makes perfect sense here. Which shade, which candle is it going with? It's just that simple. And so as long as it's just simply going with the up or the down direction of the market. Okay. All right, let me get back over here to the main discussion. I don't want to get into volume and red and green and all that stuff tonight because that's not what we're here to discuss. Let's get over here to basic constructions of candlesticks. The distinction. Let's talk about some distinctions in terms of whether it's an up day or a down day. This is another area that is often confusing, and it should not be, but I understand why it is. So let me bring a little bit of clarity. The candle body color is determined based on the closing price relative to the opening price. The closing price relative to the opening price. It is not based on whether the stock actually closed higher or lower relative to yesterday. Understand that whenever you look at a stock's price and you see the up or down, it's relative to yesterday's close. Okay, so whenever you look at the market and people say, oh, the Dow Jones was up 30 points today, it was up 30 points relative to yesterday's close, not relative to today's open. Okay, so a candlestick is relative to today's open price. And I've got several in here I want to show you. This is a good little snapshot that I could take here. Notice that this particular candle down here, we opened up here and we closed down here, okay? Well, the next morning we gapped way down here. Okay, this would be a much lower close had we closed here. Of course, in this case, the candle traded higher and we ended up closing higher, so you did end up with a positive close. But take a look at this particular candle formation. We have a white candle followed by a white candle. You see this? But this second day is actually a lower close. So why is it a white candle? Well, here's why. We opened here and we closed right over here. We closed higher than we opened, but if you look at the close relative to yesterday, yesterday's close was up here and today's close is just a little bit lower. You see that? And so that's why you've got a white candle body even though you've got a lower close. Make sense? Now let's come over here to this one up here. This is a really fascinating one, this black candle on top. We've got a black candle body, and yet we have a higher trading for the day. How does that happen? Well, for the previous day, we closed right here, and then the next day, we closed up here. Well, there's a major discrepancy right there. Not a discrepancy, but a major difference here. That could be $3 or $4 depending on the stock, okay? So we'll just call it $3. There's a $3 difference here, even though it's not specifically $3. between where we closed yesterday and where we closed on this particular black candle right here. But we've got a black candle body because we opened way up here. At one point, we traded way up here to the high. We traded all the way down to the low, and then we had the close over here. So the close is lower than the open, but it's still higher than yesterday's close. And so that's why if you looked at the balance for that day, this particular trade would have said it was up $3 or $4, however far it was, but the candlestick still turned out black. And that's really been confusing to a lot of people. Hopefully that brought a little bit of clarity to you. Does that make sense to you guys? Bev said that just brought a lot of stuff into clarification for her. So good. I'm thrilled that Bev is clear now. All right. Well, now that we've kind of clarified that, let's move forward here. Talking about some basic principles in the world of candlesticks. And George has given me an aha, and Lauren says it's much clearer for her. So good, good, good. Hey, if I can help just one person be more clear. All right, now let's talk about some basic principles. A single candle is called a candle line or a single candle line. Now, sometimes you'll hear us refer to them as single day candles. That's not really true. We shouldn't call them that, but sometimes we do because we usually work on a daily chart. And so sometimes it's easy to refer to it as a single day candle. But technically speaking, we should be referring to them as a candle line. Now, whenever you look at a single candle, it's important to realize that single candles in and of themselves do have meaning. In fact, they have a lot of meaning in and of themselves. And we're going to talk about those single candle lines tonight and what they mean. But it's also important to recognize that candles mean the most when we can combine them with multiple candles. That's when they get substantially more meaning. As a whole, what candlesticks are doing is they're a reflection of the psychology of who's winning this battle. Is it the bulls or is it the bears? This is the real battle that's going on. And so ultimately, that's going to be one of the themes that we're looking at tonight, which is who is winning the game. Is it the bulls or is it the bears? Of course, we're not talking about basketball and football here. We're talking about the stock market. But the beautiful thing about a single candle is the single candle gives us an instant reflection as to the trader's sentiment as it's related to that individual stock. So this is one of the discussions we're going to keep in mind tonight as we look at these individual candles. Think about it this way. If, let's say you've got a big white candlestick that looks something like this over here versus a white candlestick that looks like something like this right here. Which one tells you a more interesting story? And of course, most people would think, well, the one on the left is more interesting. Not particularly. They're actually equally interesting. Which one is more bearish? Well, a lot of people would think that they're equally bullish or bearish, whichever way they chose to go with it. Most people would say bullish because it's a white candle, and they would look at this and say, well, look how high it traded during the day. In reality, this upper shadow is giving us an incredible insight in terms of what's going on. You say, well, why? Well, let's look at it this way. Let's imagine for a moment that this is a sporting event. And let's imagine that it's the New England Patriots. Now, we'll call it the Indianapolis Colts. It's the Indianapolis Colts, and their seasons have looked like this forever. They're just always going up, 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 up. And then one season, something horrible happens. They were winning the season, amazing, but then Peyton Manning got hurt. And at the end of the season, it went like this. They started losing. And then, unfortunately, Peyton couldn't come back. And the next year, what happened? Well, Chicago Bears were good enough to beat the Colts. That's what happened. It was that bad. And then everything started to fall apart. And you say, well, what is the intention of that? Well, here's what it shows us. It shows us that at some point during the day, they were winning. But by the end of the day, they gave up. And in this case, of course, the analogy that I'm drawing is the Bulls and the Bears. When you have a long upper shadow like this, it tells us that at some point during the day, the Bulls were winning. But by the end of the day, even though they won, technically, it was a white candle, the Bears really had a better showing by the end of the day. Okay, and so that's why it's interesting. That's the psychology that we're getting. And every candlestick literally reflects a clear picture, at least in some way, shape, or form, of the psychology of who's winning this game, whether it be the Bulls or the Bears. Now, the second theme for tonight is not just who's winning, but the second theme is the location of where they are winning. So the key, I've listed it here, the key to interpreting candlesticks comes in the location where they appear. The key to interpreting candles comes in the location where they appear. The same candlestick formation can actually mean two different things if they occur in two different locations. Just for a quick analogy here, one of the things I like to do is tell a story. And I always like to pick out a young lady. So let me look through my list of names that are in class tonight and see who I've got. Let's see which young ladies might be here in class tonight. And I will pick on Barbara, because Barbara was the first female name that I saw. So Barbara, I don't know how old Barbara is, but tonight Barbara is going to be a young 19-year-old attractive female, and she's been going to community college, and she's been getting her nursing degree, and she's in her final semester. Very, very bright young girl. And as she's been finishing up her nursing, she has to go to her clinicals at the hospital. Well, unfortunately, Barbara was busy. She didn't get signed up for the early shift, so she has to go for the late shift at the hospital. She works from 3 to 11 p.m. At 11 p.m., she gets off, and she has to walk 4 blocks from the hospital to the subway so she can take the ride home. All right, now this happens in the middle of the night, obviously. It's 11 p.m. All right, so poor Barbara here, young, attractive 19-year-old nursing student, just about done with classes. She's been working at the hospital, and late one night, she decides, or she doesn't decide, she just happens to be running a little bit late, leaving the hospital, and she's going to miss the subway, and she knows it. So she decides that she's going to take a shortcut. Instead of walking the full 4 blocks to the subway, she's going to take a little shortcut down a dark alley in the middle of the night. Enter dramatic music. Dum, bum, bum. And so as the attractive young nursing student Barbara, at the age of 19, goes lollygagging through the alley, suddenly she hears some footsteps behind her. Click, 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 click. And what is Barbara thinking? She's thinking, I'm young, I'm 19, I'm attractive, and whoever's feet those are does not sound attractive, and it does not sound like the feet that I want following me in the middle of the night. And so she's either going to reach for her mace, or she's going to run, or do both, right? Yes. All right, so that's the story of Barbara. Now, that is a potentially negative situation. Now, let's take the exact same story and put it in a different location. Young Barbara, 19, she actually, in this case, the story's a little bit different. She didn't graduate early. She graduated a little bit late. She's staying at home, and she's got her boyfriend. Her dad does not like her boyfriend. In fact, when her boyfriend comes over, her dad brings out the shotgun, and he's cleaning his shotgun. And so Barbara, she knows if she's going to go see her boyfriend, she has to sneak out in the middle of the night. So she sneaks out her window. She's arranged to meet her boyfriend, and she sneaks out her window, and she's going to meet her boyfriend under a light post just inside the gate of her upper class community that her parents live in. There's never been a crime in 33 years in this gated community in one of the wealthiest parts of town. All right, so Barbara slips out of her window 11 p.m. at night, and she's running over to the street light, and she hears footsteps. What is Barbara thinking? She's thinking, my lover, Romeo, oh Romeo, you have come to rescue me from my crazy father with a shotgun, right? Same story, same female, 19 years old, attractive, 11 p.m. at night, footsteps. Same situation, different location. And it's an entirely different scenario. Does this make sense? Okay. Now, candlesticks are the same way. Candlesticks can take the exact same formation, but mean two exactly different things depending on the location. And that's what we're going to be looking at tonight as we're discussing single candle lines. It's imperative. And when I use the word imperative, I use it because it's a strong word. It is essential. It's imperative. It's required. You must consider the location that you're looking at when you're analyzing your candle pattern. This is where most people mess up candlestick analysis. Okay? Most people mess up by not understanding the location. So, let's jump in here and we're going to learn some of this stuff right here. Understanding that the key to understanding and interpreting candles comes in the location. You want to use your candles in the right location to confirm your Western technical skills. or Western technical signals. That's going to come from your line analysis and your chart patterns, etc. And your candlesticks are going to give you early detection and can help you confirm those Western signals. Ultimately, candlesticks are best seen as an indicator of market sentiment. All right, so with that laid as a foundation for understanding candlesticks, let's jump in and start interpreting single line candles. All right, the first candle that we're going to talk about tonight is the basic. It is the spinning top, and contrary to the name, it does not mean that it's at the top of a trend. It can be, but it doesn't have to be. The name spinning top comes from those little toys that you play with when you're a child. How many of you ever had one of those little toys that you call a spinning top? And you could spin it, and it would balance itself. That was the idea of the spinning top, is it would balance itself. And the same idea comes into the candlestick, the spinning top. Now, no, I did not create these names. Some people often think that I created the names. I did not create the names. These names are all somehow transliterated from Japanese somehow. I don't know how, but they're transliterated. All right, so candle with a small real body is a spinning top candle. Over here on the right side, you notice that I have several candles. They all have one thing in common. They all have a small real body. That is the qualification for making it a spinning top. Beyond this qualification, there are more specific terms for small candles, but the generic small candle is what we refer to as a spinning top. Now, the spinning top can be either black or white. It does not matter. You notice over here, I've got some white candles. I've got some black candles. It does not matter. They can have a long shadow. They can have a short shadow. They can have no shadow. You notice over here, I got some candles with long shadows. I got some candles with short shadows. And I even got a candle in here with no shadow. Doesn't matter. All of these candles, all 6 of them, are spinning top candles. Now, what the spinning top does is it is an early indication of a shift in trading sentiment, and it also reveals a potential change in direction. Just like the toy has balance, the spinning top toy has balance, the spinning top candle has balance. But in this case, the case of the candlestick, the spinning top candle shows a balance in the bulls and the bears. The bulls and the bears are battling it out, and they're saying, we're going to go up. No, we're going to go down. No, we're going to go up. No, we're going to go down. And as they're battling it out, up and down, you end up with actually a balance in the market. Now, a lot of people don't think this is a big deal, but it is a big deal depending on when it occurs, which we're going to look at here in just a moment. The spinning top reveals the extreme sentiment that had been driving the market has reached a balance, and that's why the spinning top is a reversal signal. It's an early reversal signal. This move that was driving the market, let's say you were in a bullish move and you had strong bullish sentiment, and suddenly that bullish sentiment has reached a battle. Well, if you've got a sudden battle, what do you have? You have bearishness that's showing up. You have bears that were not willing to enter the market way down here. Suddenly they say, hey, yeah, I'll start fighting here. And the buying pressure suddenly dries up, turns into an all-out battle between the bulls and the bears. And what this really indicates is an indecision among traders. Understand that as long as a trend is taking place, as long as a bullish move is happening, or as long as a bearish move is happening, there is some sort of consensus among traders. And that consensus is this thing needs to go up, or this trade needs to go down. You've got a whole lot more. You've got the majority that are on the side of the bullish move, or you've got the majority that are on the side of the bearish move, and the minority don't really have a say. Well, whenever you get to a pivot area and you start to see spinning tops, you've got sudden balance. In other words, there's indecision. The bulls aren't winning and the bears aren't winning. The bulls are as adamantly strong that this is a good price as the bears are strong that this is a bad price. And so the bears are selling, the bulls are buying, and we actually have a balance in the buying and selling. This is very, very often the very first candle or one of the first candles in a reversal. It can act as either a bullish or a bearish reversal signal, all depending on that ever important word, location. In fact, I often have told our students, if you want to think of the 3 most important words in candlesticks, they are also the 3 most important words in real estate. And of course, I already given it to you. Location, location, location. All right. So there you have it right there. Let me give you a couple of examples here. Showing you, there it is. A couple of examples of spinning top candles here. Notice that the market had run up. We got a spinning top right in through here. We got one right here. But notice at the peak, we got a couple spinning tops here as the market was rolling over. Okay, now in this particular picture in the middle, we've got two spinning tops right here at the bottom. Then we actually had another one that came into play right in through here. This particular picture on the right shows a little consolidation period where we've got a whole lot of spinning tops back to back. And that often happens during consolidation periods where you've got back-to-back-to-back spinning tops. In short, a spinning top is just a small candle. That's really all it is. I mean, they're so common, it's ridiculous. They're all over the place. All right, you're going to find plenty of spinning tops as you go looking for spinning tops tonight. Now let's try to figure out why my drawing tool has stopped closing. There it is. All right. Now, let's talk about the next qualification of the spinning top, and that is the high wave candle. This is a spinning top, okay? The confusion sometimes people say, well, what's the difference in a high wave and a spinning top? Well, a high wave is a spinning top. It's just a more specific spinning top. It is a spinning top that has an extra long upper and lower shadow. Extra long upper and lower shadow. Now, if the spinning top showed indecision in the market, the high wave candle shows downright confusion. You say, why would this be so confusing? Well, I'll show you why. In order to create this candlestick over here on the right, what must happen in the market? Well, let's just break this thing down. Understand that we've got the opening price, we've got the high price, we've got the low, and we got the close. In order for this candlestick to be created, the market had to open somewhere. Okay? And let's say that immediately, that was at 9:30 in the morning. Okay? And then immediately, let's say the bears came rushing into the market and they sold off drastically. Now, if by 11 o'clock in the morning you saw this picture, how many of you would be thinking that that was a bearish day? Most of you would be in congruence. Yeah, that's a pretty bearish day, right? Well, interestingly enough, you leave for lunch and you think everything's bearish, but by the time you come back from lunch at 2 o'clock in the afternoon, this is the candlestick. The day has progressed. The candle has progressed. And now everything that looked extremely bearish at lunchtime by your afternoon snack looks extremely bullish. And of course, in order to create this candle, by the end of the day, the bears must have also come back in and closed it so that you end up with an open, a high, a low, and a close by 4:30 that looks like this candlestick right here. You end up with a long upper shadow and a long lower shadow. What do the long upper and lower shadows indicate? They indicate extreme buying pressure mixed with extreme selling pressure. And because of this extreme buying and extreme selling pressure, we have downright confusion in the market. If you've never traded a day where you have this kind of a candlestick that gets formed, you've never really ridden a roller coaster, because you look at it and you think, oh, my trade's going that direction. Come back in the afternoon, and it just flipped the directions on you there and really frustrates you. Well, that's called a high wave candle. It shows extreme confusion in the market and very, very often leads to reversal, or at least some sort of a change in trend in the market. All right, let's take a look at a couple of high wave candles in practice. There's actually a pretty high wave candle up here at the top of this swing. As it swung on down here, really nice high wave candles back to back right in through here. Lots of indecision in the market. Had a nice big high wave candle right here at the bottom of this swing. And in this particular swing over here, there was a nice high wave over on the right. There was another one, not the best one here in the middle, but it was technically more of a high wave candle than anything else right here in the middle. So there's several high wave candles kind of in a context that you can get a feel for what the moves looked like with these particular candles. All right, now, as you consider spinning tops and high wave candles, generic spinning top and high wave candles can occur in either up or down swings. Doesn't matter. It can go either direction. They mean the most during a trend at a pivot point. There's one of your highlight points. They mean the most during a trend at a pivot point. During a market rest, such as a flag or a pennant pattern, they don't mean a whole lot. But if you're trading along, you get to a pivot area, and you see a high wave or a spinning top, you need to like put your little antennas up and say, wait a second here, something's going on. I've got to a pivot area. This is where transitions occur, and suddenly my candlesticks are telling me that things have changed. No longer do I have these strong bullish sentiments that I used to have here. Okay? Does this make sense to you? All right, let's look at some context here of spinning tops and high waves, kind of all of them clustered together here. Notice how frequent they are. There's all sorts of spinning tops in here. They're all over the place. Spinning tops all over the place, and I'm going to show you some more specific names here in a moment. And just take a look at how common they are. Very, very common. Most of them, if you were to draw a line through here, you realize that this whole section was a resistance area on Amazon, and look at all the spinning tops that happen in those little consolidation areas in through here. Okay, so very, very common. We see them quite often. Now, the next sequence, the next several single line candles I'm going to show you are all spinning top candles, but they're very specific. And that's why we get into them, because they're very, very specific in when they occur and what they mean. The first one we're going to look at is the hangman. The hangman candlestick. The hangman is going to occur at the top of an upswing. Okay, so you can see from my image here that the trade was trading higher, and then we got our hangman. Okay, now here's what the hangman is characterized by. It's characterized by a small real body, which is your spinning top, a long lower shadow, which is 2 to 3 times the size of the real body, little or no upper shadow. Notice that there's no upper shadow up here, and it can be either black or white. It does not matter. Small real body, long lower shadow, 2 to 3 times the size of the real body, little or no upper shadow, maybe black or white. Question for you guys, is this a hangman, yes or no? What do you think? Is this a hangman, yes or no? All right, the answer is no. Why? Because there's not enough lower shadow. Everybody who said yes, the answer is no. There's only a few of you that said yes. I want to address Michael Baum's commentary. Michael Baum has written in here, and I'm a little bit late to the comment, but I'm still going to address it. He says, what about sentiment among traders? There are computers buying and selling, right? Go look at the last half hour of the Dow on 5-minute bars trading in a very narrow range within the ending ascending triangle. What 5 guys managed to trade up and down to the end of the triangle? I argue Jeremy about trader sentiment. The computer is messing up the market. That is a myth, in my opinion, Michael. It is a common perpetualized myth. But here's my question for you. Who programs the computer? 90% of my trades or more are exercised by the computer doing the trade. I give it the criteria and I say, go do it. Who programmed it? The answer, of course, is me. Behind every computer program is a human being. And so, Michael, it's nice to blame a computer, but what it really means is it really probably means that the people who are getting taken advantage of and losing money in those opportunities they're just on the wrong side of the trade. That's what I'm trying to say. The best example I can bring into this actually comes into the myth that's perpetuated by market makers messing up the market. People often say that the market makers ran your stops. So they say, I set my stops, stock traded right down to my stop area, stopped me out, and then it went the other direction. It's the dang market makers. And I say that that's just an excuse. It's an excuse for putting the blame on somebody else. And the best example of that, it was a student of ours, I can't remember her name right now, but she had done the trader conditioning system. And of course, if you've done the trader conditioning system, you know that there is no human beings involved. It's just you and the stock. And so she was doing the trader conditioning system, and she wrote in with her major aha. She said she couldn't figure it out. In real life, all of her stops kept getting run by market makers. And then she started doing the trader conditioning system, and in the trader conditioning system, all of her stops kept getting run by market makers. But of course, that was physically impossible because there were no market makers in the trader conditioning system. What she discovered is she was setting her stops poorly. And so what I would say to people who say the computer is messing everything up and jacking it all up in the market, I would counter to that and say, no, you've got to allocate for that. Know what the other traders who are programming the computers are thinking, and you have to react to that. It's all part of the game. Just because they've got a faster handsaw than you have doesn't mean that you both can't build a house. It's just a matter of the tools of the game. And if you're going to compete, then you learn to analyze what's going on in the market. So I actually 100% push back on that. I think it's an excuse. And even though we hear it propagated from very high levels, I think the idea of high frequency trading and computers messing everything up is just an excuse. And rather, what I'd rather see us say is, as a trader, we can get better and we can do better ourselves. That's what I'd rather see happen. All right, so that is my personal opinion on it, and you guys can take that for what it's worth. Probably not the right side discussion for tonight, but I got off on it. Oops, sorry. All right, continuing our discussion on a hangman, recap really fast here. Hangman occur at the top of an upswing characterized by small real body, that is a spinning top, long lower shadow, 2 to 3 times the size of the real body, little or no upper shadow, maybe black or white candle body. All right, let's talk about how we use them. The hangman is going to reveal a change in market sentiment. It can precede a bearish reversal. Look at the context, ladies and gentlemen. Location. Upswing precedes a bearish reversal. However, you need to recognize this next bullet point here. It is a weak signal, meaning it is not the strongest signal. Very popular. A lot of people know what they are. A lot of people are excited about them when they see a hangman. Doesn't really mean a whole lot oftentimes. And the reason is because it's probably the most bullish of all of our bearish reversal signals. So we'll talk about that in a second. But whenever you do see a hangman, what you want to do before you jump into a bearish trade is seriously wait for more confirmation before turning bearish with this particular signal. It's not a super strong signal. It can precede a bearish reversal. More often what I see with a hangman is I see that it precedes a move from either a bullish trend. Well, it's always in a bullish trend. So it'll precede a move from a bullish trend into a sideways move more often than not. And then maybe eventually into a reversal or eventually into a continuation. But it just kind of signals a slowdown more than anything. Now, here's my question for you. Why would this be a weak reversal signal? Any ideas why this would be a weak reversal signal? As a clue, I've told you, the lower shadow. Is it bullish or bearish? The lower shadow. Is it bullish or bearish? Some of you said bearish already. I'm still having to train you, but that's okay. Let's ask the question, how does this candle get formed? By the way, I'm giving you guys a clue into how to interpret market data. Have you ever noticed whenever we start talking about, I ask you questions, is it bullish or bearish? How do I respond? I respond by asking another question. This is your ticket to getting where you want to go in the market. Learn to ask better questions. When you see a candlestick, even if you don't know what the name of the candlestick is, ask yourself, how could it have gotten formed? Therefore, what could the meaning be behind it? So let's ask ourselves, how did this candle get formed? Well, first of all, we had a bullish trend that led up to it. Okay, so that's the first thing that happened. Bullish trend leading up to it. And then within a single trading day, starting at 9:30 in the morning, we opened the candle. Okay, so from 9:30 until whenever, we started trading in one direction. And it looks like initially there's a good chance that the candle started by trading down, which means it would have been bearish. Now, coming out of a bullish trend, a downward bearish move would be bearish. You guys can see that. So that bearish lower candle, that lower shadow, initially would have been bearish. But in order for that candlestick to have a lower shadow instead of a long black candle body, what must happen? Well, the bulls, we'll call that 11 o'clock, the bulls must fight back. And by 4:30, I don't care when it happened during the day, it really doesn't matter. By 4:30, that was the end story. So the bulls fought back. They regained all that territory, and they ended up, in this case, winning the game. Now remember, to be a hangman, it could be black or white. It doesn't matter. This candle could have just as easily looked like this. It would not have mattered one bit. It still would be a hangman. But the story of this candle is, by the end of the day, the bulls came back, and that all happened in the context of a bullish trend. So whenever I see a hangman, I make note, and I say, note, hangman, I've got a spinning top, and the spinning top is a reversal signal, but I've also got a long lower shadow, which tells me that the bulls made a valiant effort by the end of the day. And sometimes you have an off day. Sometimes you have a game where, you don't play so great, but if you still come back at the end of the game, you're getting your act together. That's the nature of the hangman. So the hangman, in my opinion, is one of the weaker reversal signals. Now I've got a couple in here to show you. This particular one right here actually ends up working really well as a reversal because it sets up as a 3-day reversal pattern that we'll talk about in the next class. But right in the middle, there was a hangman. You see that hangman right there? Hangman. Okay, so long lower shadow, small real body. Come on over here to the right example. I should say the example on the right side. There's another hangman, and this particular chart, as of this picture here, had not reversed yet, had not even given any signs of reversal. Look at this nice long bullish trend. We had one slowdown, kind of a high wave candle here, and then the most recent day we had a hangman, and we don't know what happened next, because you see, this could